Hi everyone, welcome to the session. In this session, let's look at IAS 40 and some questions relating to this particular standard. First of all, let's look at some of the important interpretation or the explanations relating to IAS 40. Then we'll move on to the question and answers session. Okay, so first of all, let's look at IAS 40. What is the definition of IAS 40? So what is an investment property? Investment property is property, either land or building or part of building or both, held by the owner or by the lessee under a finance lease to earn rentals. This is very important, to earn rentals or capital appreciation or both. Let's say you have a property, this is a property, okay? And if this property is held to earn rentals or capital appreciation. So in this case, capital appreciation means you are holding this property with the intention of getting an increased value of the property, okay? So in that case, this property, the plot of land or the building, will be treated as investment property. So it can be the whole property or part of the property, okay? So land or building or part of a building. So for example, let's say these are the entire building. So this part is given on rent. Okay. So therefore, this can be treated as investment property, this part. Okay. So this is the meaning of investment property. So what are the examples of investment property? According to IAS 40, land held for long-term capital appreciation. Okay. So if the land or building held for capital appreciation, so that is known as investment property. That can be treated as investment property. And also land held for the currently undetermined future use. Okay, so you don't know what the company is going to do. Okay, so therefore those kind of properties also will be treated as investment property. Okay, so land held for the currently undetermined future use. Okay, so that is an investment property. Building leased out under an operating lease. So that also will be treated as what you call investment property. Vacant building held to be leased out under an operating lease. So in this situation also, the property will be treated as investment property. Then property that is being constructed or developed for future use as investment property. If the building is constructed in order to rent it out or for capital appreciation, so that property is known as IAS 40 investment properties. Okay, so these are the basic examples for investment property. Then the following are not investment property. What are those? Property held for use in the production or supply of goods or services or for administrative purposes. Okay, or else property held for sale in the ordinary course of business or in the process of construction of development for such sale. So this will be treated as inventories in that case, if it is held for sale. If it is property held for use in the production or supply of goods, so these are under PPE. And also property being constructed or developed on behalf of third parties, so that will be covered under IAS 11 construction contracts. Then owner occupied property, IAS 90, property, plant and equipment including property held for future use as owner occupied property, property held for future development and subsequent use as owner occupied property, property occupied by employees and owner occupied property awaiting disposal. Okay, so all these will be treated as IAS 16. Property leased to another entity under finance lease. Okay, so these will not fall under IAS 40. Okay, so now what is the treatment under IAS 40? Let's look at the treatment. How do you recognize the investment property? The initial measurement. The investment property is initially measured at cost, including transaction cost. Such cost should not include startup cost, abnormal waste, or initial operating losses incurred before the investment property achieves the planned level of occupancy. Okay, so basically, the initial measurement should be at cost. Then measurement subsequent to initial recognition. There are two ways where you can recognize. Either it can be a fair value or at cost. Okay. One method must be adopted for all of an entity's investment property. Change is permitted only if this result in a more appropriate presentation. IAS 40 notes that this is highly unlikely for a change from a fair value model to a cost model. Okay, so therefore, subsequent measurement should be either fair value or cost model. Okay, but if you adopt one method, it has to be used for the entire investment property of the company. Okay, so one method must be adopted for all of an entity's investment property. Okay, so if you are going to change, then the justification should be it has to be more appropriate presentation. So in that situation only change is permitted under IAS 40. Now let's look at based on this to answer these questions. Okay, first of all, let's say the first question. AG Private Limited, AG is a real estate company and its financial year end is 30th June. AG held the following properties as at 30th June 2020. Land 1, AG acquired this land in August 2019 for 10 million. The company has not yet decided on how it would use this land in the future. The net realizable value as at 30th June 2020 was 30 million and the fair value as at 30th June 2020 was 13.7 million. Okay, so as you can clearly understand from this particular para, the company has not yet decided on how it would use this particular land. Okay, so according to IAS 40, it says land held for a currently undetermined future use. Okay, if the land is held for a currently undetermined future use, so it will be treated as an investment property. So therefore, this particular land should be treated as investment property. Okay, this is investment property. Okay, so you are given the cost, the net realizable value, and the fair value, 13.7 million and 13 million. So what is the value that you need to recognize? Because AG PLC measures its investment property at fair value. Here it's given AG prepares its financial statement using full IFRS and measures investment property at fair value. And land and building classified as property, plant, and equipment are measured at revalued amount. So therefore, the company adopts a fair value model. So therefore, this property is an investment property, land 1. So therefore, it has to be valued at fair value. So if you take the land 1, so this is an investment property. So it has to be valued at fair value. So the amount will be 13.7 million. 13.7 million. So difference in the net realizable value and 13.7 million, which is 3.7 million. Sorry, the cost. The cost is 10 million. So therefore, fair value is 13.7, the cost is 10 million. The 3.7 million has to be recognized in the income statement. Okay, this is the treatment. Second one, land number 2. AG acquired this land for 30 million with the intention of selling it in the normal course of business. However, the company is aware that it will take some time for the economy to recover from COVID-19 pandemic and it will be difficult to find buyers to sell the land. Therefore, AG decided to rent the land to another company as a car park for a short period of time until the land is sold. The fair value of the land is, as at 30th June 2020, was 34 million. The net realizable value, 32 million. The cost was 30 million. So how do you treat this particular land? What is the intention? The intention is selling. The intention is to sell the land in the normal course of business. So therefore, the property is intended for sale in the ordinary course of the business. So therefore, this will be treated as the land 2 will be treated as an inventory. Okay, because this land is to be sold. Okay, so intention is to sell. Okay, so therefore this is an inventory. So therefore this has to be recognized at the lower of cost or net realizable value. So therefore, how much is the cost? Cost is 30 million and net realizable value is 32 million. So therefore, this has to be recorded at 30 million. Building number 1. This building was acquired in July 2019 at a cost of 20 million and it had a useful life of 30 years. The building was occupied by 2 tenants under operating leases. Both tenants vacated the property due to the decline of the business resulting from the distressed economic environment under COVID-19. Therefore, the building was vacant as at 30th June 2020. AG is trying to find new tenants for the building as at 30th June 2020. The fair value of the building was 22 million. Okay, so what is the scenario here? The building was acquired at a cost of 20 million and this was occupied by 2 tenants under operating lease. So this was given on operating lease. So therefore, as per IAS 40, IAS 40 says building leased out under an operating lease should be an investment property. And also, if the building is vacant building and held to be leased out under an operating lease, so that also falls under investment property. So therefore, this property is currently vacant but this property is vacant as of 30th June, but they are trying to find new tenants to be leased out. So therefore, this particular building number one is to be treated as, this has to be treated as investment property. So therefore, the company adopts the fair value measurement, fair value model. So therefore, the building has to be valued at 22 million. So 22 million is the fair value, whereas the cost is 20 million. So therefore, this 2 million to be recognized in the income statement. Okay. And the last one, the building under construction. The cost incurred for construction up to 30th June 2020 was 20 million. After construction is completed, AG will rent this building. Okay. After completing the building construction, this will be rented out to a few educational institutions. The fair value of the work completed as of 30th June 23 million. The building is being constructed on a land obtained under a lease for a period of 50 years. AG prepaid the future lease payments amounting to 130 million on 1st July 2019, which was the date of the commencement of the lease. The fair value of the lease hold interest as at 30th June 2020 was estimated at 135 million. Here there are 2 things that you need to consider. First one is the building construction. So in this case, you have to consider 2 things. First one is the building construction. And what is the purpose? What is the purpose of constructing the building? Is to rent out. Okay. So standard clearly says if the building is under construction and the intention is to rent it out, so that has to be treated as investment property. Okay. This is investment property. So the company adopts the fair value measurement. So what is the fair value? Fair value of this building. The fair value of the work completed as at 30th June 2020 was 23 million. And how much was the cost? 20 million. So therefore, this 3 million to be recognized in the income statement as profit. Okay. Apart from that, the land on which the building was constructed also meets the definition of investment property, because this property, since the property will be used to earn rental income, okay, this land obtained on a lease, and this land is used to earn rental income. So therefore, this land also should be considered as investment property. So therefore, the fair value of the land is 30 million and 135 million, not 30 million, it is 135 million. And the cost, the lease payment was 130 million. So therefore, 5 million should go to the income statement as fair value gain. That's all for today. So thanks for watching, and I will see you soon with another video. So until then, bye.